Well, good to be here. It's funny. After all these years, people still want to hear an old fellow from Omaha ramble on about stocks and businesses. I guess there's something to be said for just sticking with the simple stuff, the things that make sense. Most of what I've learned isn't rocket science, and it certainly doesn't require 160 IQ. In fact, sometimes a lower IQ might even be an advantage, keeping you from overthinking things. But let me tell you, I've made my share of bonehead mistakes, more than I care to count. And usually the lessons learned from those mistakes stick the best. Back in the early 1960s, specifically starting in 1962, I began buying shares of a New England textile company called Berkshire Hathaway. I was poking around looking for what Ben Graham called cigar butts companies, so cheap that they were worth more liquidated than as ongoing concerns, just enough of a puff left to make a profit. I paid around $7.60 a share, thinking I was getting a real bargain on a struggling business. A classic Ben Graham situation. The company had a fair amount of working capital, more than its market price, in fact, which made it look tempting on paper. What a foolish way to think about a business, even if it eventually led to the Berkshire Hathaway we know today. My initial thought was that I could squeeze out some quick profits, sell off the assets, and move on. Little did I know I was stepping into a capital-intensive quagmire. The textile business was a nightmare, fighting against cheaper imports from abroad, dealing with demanding labor unions, and requiring constant heavy reinvestment just to keep the old machinery running. Every time we thought we were turning the corner, we'd have to pour more money into the mills, like throwing good money after bad. It was a dying industry, plain and simple, and no amount of brilliant management or clever financial engineering could change that. The competitive dynamics were just stacked against us. I remember getting into a rather petty spat with the management in 1964 over them offering to buy back my shares at a price slightly lower than what they had indicated. Out of sheer stubbornness and a bit of a childish desire to get even, I ended up buying control of the company in 1965 for 14. That stubborn, impulsive decision to gain control, fueled by a trivial disagreement, locked up a significant amount of capital for years in a terrible business. The textile operations, they consistently destroyed capital. We kept trying to make it work, but it was like running uphill in the mud. By the time we finally closed the textile mills in 1985, after 2 decades of futility, we had poured countless millions into them, all of which simply vanished. The capital could have been earning outstanding returns elsewhere. Charlie always reminds me that a bad business at a good price is still a bad business, and he was right, as he usually is. I often joke that buying Berkshire Hathaway as a textile company was a $200 billion mistake if you consider the opportunity cost of that capital, had it been invested in a truly wonderful business from the start. It was a painful, prolonged lesson in understanding business fundamentals rather than just balance sheet numbers. Here's what I learned from that long drawn out experience with Berkshire's original textile business. Price is what you pay, but value is what you get. And what I was getting with those textile mills, despite the low price, was a business with no enduring competitive advantage, no moat. Ben Graham, my old professor at Columbia, taught me the importance of a margin of safety, buying something for significantly less than its intrinsic value. That's still the bedrock of our investing philosophy. But Phil Fisher, another great investor, really opened my eyes to the importance of scuttlebutt, getting out and talking to customers, suppliers, competitors, understanding the qualitative aspects of a business. He taught me that growth at a reasonable price in a business that truly understood its competitive position could be far more powerful than just buying cheap assets. I combined those 2 lessons over time. Investing, you see, is like picking a baseball team. You don't just look for players who are undervalued because they had a bad season last year. You want players with a demonstrated ability to hit home runs and play great defense who will be consistent performers year after year. You want a durable franchise. The textile business was like a player who was always on the bench, needing constant medical attention. And even when he played, he struck out a lot. You want businesses that can earn high returns on capital without needing constant infusions of cash just to stay afloat. That's where the real magic of compounding interest comes in. You want to own a piece of a business that is growing and strengthening its competitive position over time, letting your capital compound within that strong business. This reminded me When my dad taught me about money and responsibility early on, he ran a stock brokerage during the Depression. So I saw firsthand what fear and uncertainty could do to markets, but also the enduring power of good businesses. He always emphasized living within your means and understanding what you own. When I was just 11, I bought my first stock, City Service Preferred, for $38 a share. It dropped to $27, and I was terrified. Then it went back up to $40, and I sold it for a small profit. Of course, it then zoomed to $200 a share. That taught me another early lesson. Impatience can be just as costly as stubbornness. It reinforced the idea of holding on to good businesses for the long term and not letting emotions dictate decisions. Charlie, my partner, always says it's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. That's the truth of it. We just try to avoid stupidity, avoid businesses that are destined to struggle, and instead focus on quality. You don't need fancy algorithms or complex financial models to understand this. It's really quite simple. Find outstanding businesses with durable competitive advantages, run by honest and capable managers, and buy them at a fair price. Then do nothing. Just let them compound over the years. That's the secret, if there is one. When we bought See's Candies back in 1972 for $25 million, people thought we were crazy. It was a seemingly mundane candy company in California, but what we saw was a phenomenal business with brand loyalty, pricing power, and a simple, understandable product. It had a strong economic moat. See's didn't require massive capital investment to grow, and it had consistently high returns on invested capital. Over the years, See's has generated well over $2 billion in pre-tax profits for Berkshire, all from that initial $25 million investment. And every dollar of profit that See's sends us, we then redeploy into other wonderful businesses. That's the kind of business we love, a cash cow that keeps giving, allowing us to allocate capital elsewhere. Or take Coca-Cola. We started buying shares in 1988, investing about $1.3 billion over a few years. At the time, Coke was an incredible global brand selling a simple, low-cost product with universal appeal. It had a massive distribution network and a deeply ingrained place in people's daily lives. Today, that investment is worth many, many multiples of what we paid for it, and it pays us hundreds of millions of dollars in dividends every year. It's a testament to the power of a truly wide moat, a product that brings joy to billions and a business that continues to execute year after year. We didn't need to predict new technologies or market trends. We just understood the enduring power of a great brand and a simple, addictive product. Now, we've had our share of misses too, of course. Dexter Shoes, for example. In 1993, we bought Dexter Shoes for $43 million in Berkshire stock. I should have known better. The shoe industry was going the way of textiles, facing relentless competition from low-cost producers overseas. I ignored the deteriorating competitive landscape, blinded by the idea that it was a well-managed American company. What made it even worse was that I paid for it with Berkshire stock, effectively affecting pieces of our good businesses for a bad one. That mistake, if you count the lost compounding on the Berkshire shares I issued, probably cost us billions. It was a reminder that even I can get swayed by sentiment or a superficial analysis, and that paying with your own stock for a bad business is a cardinal sin. If you're a young investor today, just starting out, here's what I tell my younger self. The most important thing is to start early and understand the magic of compounding. Even if it's just a little bit, consistently investing in a broad market index fund or a handful of solid, understandable businesses can lead to incredible wealth over a lifetime. You don't need to do extraordinary things to get extraordinary results. What you need is patience, discipline, and the ability to think independently. Don't listen to the talking heads on TV, and certainly don't chase hot stocks or fads. The market is there to serve you, not instruct you. It's a voting machine in the short run, but a weighing machine in the long run. People think you need to be constantly active in the market, buying and selling, trying to time things. But actually the opposite is true. Our favorite holding period is forever. We buy businesses with the intention of owning them permanently, assuming they continue to be great businesses. Imagine you're buying a farm. You wouldn't check the price of your farm every day, would you? You'd look at the harvested productivity of the land. It's the same with businesses. Focus on the underlying business results, not the daily gyrations of the stock market. Those price fluctuations are just Mr. Market, a manic depressive fellow, offering you a price every day. Sometimes he's ecstatic and offers you a high price. Other times he's depressed and offers you a low price. You don't have to trade with him unless it suits you. This applies to any business, not just to investing in publicly traded companies. What really matters in business is building something that provides value efficiently and consistently for a long time. Whether you're running a lemonade stand or a Fortune 500 company, you need a strong product or service, loyal customers, and a sustainable competitive advantage. We look for businesses with moats, things that protect them from competition, whether it's a strong brand, a patent, a unique distribution channel, or simply being the lowest cost producer. The wider the moat, the better. And you need good management, people who are honest, capable, and dedicated to the shareholders. We want managers who run the business as if it were their own, not just for their own personal gain. Charlie and I spent a lot of time thinking about these moats. We want to buy businesses so wonderful that an idiot could run them, because eventually one will. That's a bit of an exaggeration, of course, because good management matters immensely. But the point is, a business with a truly formidable moat can withstand some pretty average management for a while. A weak business, however, will be destroyed even by brilliant management trying to save it. That's why we focus on intrinsic business quality first and foremost. We want to understand how a business makes money, how sustainable those earnings are, and what makes it special in the marketplace. But that's not the only lesson I learned the hard way. This reminds me of another time when I let personal feelings cloud my judgment, costing Berkshire millions. And it involved an industry that many people thought was invincible, airlines. The truth is, sometimes, even after you've learned a lesson, human nature can still tug at you. You can read all the books, listen to all the advice, but nothing quite drives a point home like losing a pile of your own money. The good news is, sometimes if you're lucky, you get a chance to learn that same lesson twice, and maybe, just maybe, it sticks the second time. In the late 1980s, I made a significant investment in U.S. Air preferred stock totaling around $358 million. The airline industry, even then, was notorious for being cyclical, capital intensive, and prone to ruinous price wars. I knew all of this theoretically. Ben Graham always warned against commodity-like businesses with no pricing power. Yet, I bought in. I remember sitting in my office in Omaha looking at the numbers and thinking that the preferred shares offered a high dividend yield, seemed like a margin of safety. What I failed to appreciate fully was that a high yield in a troubled industry can quickly become no yield at all.
Soon after, the airline industry hit a downturn, and U.S. Air, along with its competitors, started bleeding money. The preferred dividends were suspended. My investment, which I thought was safe because of the high yield, quickly looked like it could go to zero. I remember Charlie looking at me with that characteristic Munger smirk, probably thinking, there goes old Warren again, buying into another terrible industry. We ended up selling the bulk of our U.S. Air position in the mid-1990s, taking a substantial loss, but managing to salvage some value through a recapitalization. My initial investment was $358 million, and by the time we exited, the value of the shares had been severely impaired. The whole affair was deeply painful, a public example of my lapse in judgment.
What I learned from U.S. Air and what Charlie had been saying for years is that the intrinsic characteristics of the business itself are what determine the investment outcome, not how cheap the stock looks today. The industry structure, the competitive forces, the need for constant capital expenditure, these were all screaming bad business, but I let the attractive dividend yield seduce me. It was another harsh lesson in understanding the difference between price and value, and crucially, between a cheap stock and a wonderful business. Rule number one, never lose money. Rule number two, never forget rule number one. And here I was, violating both with a high-profile, substantial investment. Fast forward to 2016, and what do you know? I started buying airline stocks again. American, Delta, Southwest, United. Many thought I'd lost my mind. I'd called airlines a death trap for investors for years. What changed? Well, the industry structure had shifted. Consolidation had led to fewer, stronger players. Pricing power had improved. Load factors were up. Fuel costs were more stable. The balance sheets were stronger. For a time, it seemed like the moats had widened. So Charlie and I made significant investments. We accumulated billions of dollars worth of shares in the big four U.S. airlines. I thought perhaps that the industry had matured to a point where it was no longer a value trap. Then came COVID-19. Suddenly, the entire industry was grounded. Planes were sitting idle, cash was burning, and the outlook was bleak. This was an unforeseen external shock, something that couldn't have been predicted. But it highlighted the fragility of even seemingly improved businesses in a capital-intensive, high fixed cost industry when demand vanishes overnight. We sold all of our airline stakes in early 2020 at a significant loss. I openly admitted it was my mistake. The world had changed dramatically. I still believe the initial thesis that the industry structure had improved was correct before the pandemic, but when the facts change, you have to change your mind. It was a painful reminder that even the best analysis can be undone by an unpredictable event, and that certain industries inherently carry more risk. It also highlighted the importance of having businesses in your portfolio that can withstand unforeseen shocks. So, what do? You stick to what you understand, your circle of competence. I talk about this a lot. If you stay within your circle, you don't need to be right about everything, but you need to understand what you know and what you don't know. My circle of competence has always been more about predictable consumer goods, insurance, and financial services. I largely stayed away from tech for a long time because I just didn't understand how to predict their long-term competitive advantages. What's a moat in tech? It changes so fast. Now, people will point to Apple and they'll say, but Warren, you invested heavily in Apple. Isn't that a tech company? And you'd be right to ask that. But we didn't buy Apple because we thought we could predict the next iPhone model or the latest software innovation. We bought Apple because we view it as a consumer products company with an incredibly sticky ecosystem, tremendous brand loyalty, and a powerful relationship with its customers. It's almost like a utility to many people. That's a huge moat. It's a business where the customer is paying a lot of money, but they feel like they're getting enormous value and they're incredibly brand loyal. That's what we understand. It fell within our redefined circle of competence. Over at Berkshire, we've always looked for businesses that generate free cash flow, have strong management, and operate in industries we can comprehend. That's why we love companies like Geico, which has a fantastic brand and a low-cost operating structure. We bought into Geico fully in 1996, but I had known them since I was a student of Ben Graham in the early 1950s. I even traveled to their offices in Washington, D.C. on a Saturday morning to learn about the business. It was clearly a company with a tremendous future, a direct-to-consumer model that was highly efficient. That sort of foresight, combined with a willingness to wait for the right price, that's powerful. My dad taught me to read everything I could get my hands on, and I still do. I spend 5 to 6 hours a day reading annual reports, 10Ks, industry journals, newspapers, anything that helps me understand businesses in the world. Charlie and I are big believers in continuous learning. You don't get smarter by chasing the latest trends. You get smarter by absorbing information, understanding fundamentals, and thinking critically. You want to constantly be filling your brain with useful knowledge, which often means reading about things that have been around for a long time rather than just the latest hot topic on the internet. The truth is, investing success doesn't require a lot of fancy math or complex economic theories. It requires sound judgment, emotional control, and a long-term perspective. It means being patient and waiting for fat pitches, like a baseball batter waiting for the perfect ball to swing at. You don't have to swing at every pitch. You can just stand there and watch them go by, waiting for the one you know you can hit out of the park. When I was running my partnership in the 1960s, I often had long periods where I did nothing, just patiently waited for the right opportunity. Most people find that incredibly difficult to do. They feel they have to be doing something all the time. One of my absolute favorite holding periods is forever. We want to buy businesses that we would be happy to own, even if the stock market closed for 5 years. That means focusing on the underlying value of the business, its earnings power, its competitive position. We try to determine intrinsic value, what the business is truly worth based on its future cash flows, and then we buy it at a significant discount to that value. That's been Graham's margin of safety at work. It protects you from unexpected bumps in the road and gives you a greater chance of success. It means you don't have to be precisely right in your calculations, which is good because you never can be. You know, at our annual shareholder meetings in Omaha, we get 40,000 people showing up. It's quite a spectacle. And every year someone asks about how to get rich quick or how to make $1 million by next Tuesday. And my answer is always the same. There's no secret formula, no magic bullet. It's about patience, discipline, and thinking like a business owner, not a stock speculator. It's about buying a piece of a wonderful business, not just a ticker symbol, and letting compound interest do its work over many decades. Compound interest is the eighth wonder of the world if you can just leave it alone to do its job. Another critical lesson is to never borrow money for investing. I've seen so many smart people get wiped out because they leverage themselves to the hilt only to be caught in a market downturn. Rule number one is never lose money, and that significantly increases your chances of doing just that. Living modestly and investing your own savings, letting your capital grow over time, that's the way to build wealth that lasts. I still live in the house I bought in Omaha in 1958 for $31,500. It's plenty big enough. You don't need the fancy stuff to be happy, and you certainly don't need it to be a successful investor. The less you spend, the more you have to invest. It's that simple. It's about temperament more than intellect. You need emotional stability. You need to be able to resist the urge to panic when everyone else is panicking, and resist the urge to get greedy when everyone else is euphoric. Be fearful when others are greedy, and greedy when others are fearful. That's an old saying, but it's true today as it ever was. When the market is in a frenzy, that's when you need to be cautious. When there's blood in the streets, that's when you should be looking for opportunities, assuming they are in fundamentally sound businesses that you understand. One more thing about human nature. People love complexity. They think if something is complex, it must be smart. But the truth is, the best businesses, the best investments are often remarkably simple. Think about Coca-Cola, See's Candies, or even something like Dairy Queen, which we own. Simple products, simple business models, but executed brilliantly over many decades. You don't need to understand quantum physics to invest well. You just need to understand basic economics, basic accounting, and basic human behavior. The simpler it is, the easier it is to understand, and the less likely you are to make a catastrophic mistake. What Charlie and I have always tried to do at Berkshire is buy wonderful companies at fair prices rather than fair companies at wonderful prices. That's crucial distinction. A wonderful company will continue to grow its intrinsic value over time, creating more wealth for you even if you pay a reasonable price for it. A fair company, even if you buy it cheap, might struggle to grow or might even decline, and you won't make much money. It goes back to the idea of buying quality. We want businesses that have consistently high returns on tangible capital, businesses that can generate a lot of cash without needing to constantly reinvest huge amounts just to stand still. Look, I'm 94 now, and if I could tell young investors one thing, it would be this: focus on the long term. Seriously, the long term. Short-term market noise, daily fluctuations, quarterly earnings reports, these are mostly distractions. Think about owning a piece of a business for a decade, 2 decades, or even more. That perspective changes everything. It changes what you look for how you evaluate risks, and how you react to temporary setbacks. Most of the real wealth in America has been built by people who bought a good business and held on to it. And never ever bet against America. I've seen this country go through depressions, recessions, wars, and all sorts of crises. But the human ingenuity, the drive, the free market system, it always finds a way to move forward, to innovate, to create more prosperity. Sometimes people get gloomy, especially now, and they forget the incredible resilience and dynamism of the American economy. But if you have faith in that, if you believe in the power of free enterprise and human progress, then investing in good American businesses for the long run is one of the smartest things you can do. So after all these years of doing this, here's what I know for certain. You don't need to be brilliant to be a successful investor. You don't need inside information or a fancy degree or a hot stock tip. What you need is a sound intellectual framework, patience, discipline, and the ability to control your emotions. Find truly good businesses that you understand, buy them at a fair price with a margin of safety, and then just sit on them. Let compound interest do its magic. It's really that simple. Focus on what you know. Stay humble about what you don't. Learn from your mistakes, and boy, have I made plenty of those. And let time be your friend. The biggest advantage you have as a young investor is time. Use it wisely. Don't get caught up in the madness of crowds. Just keep learning, keep saving, and keep looking for those wonderful businesses. Good luck to you all.